Good morning, everyone, and welcome to this week's podcast from December the 27th, 2021. Hope everyone had a nice holiday. Had a little bit of a break with the holiday weekend coming up, so we took a little bit of a trading day off on Friday, but still nonetheless had quite an eventful week for what was originally meant to be considered a slow week for most, but still had quite a bit go on this week. And even this morning when we come in to take a look at a number of the charts, we've had a lot go on, namely looking at the chart of the S&P 500 here this morning. We've seen the S&P 500 break out to new all-time highs on its default chart, moving up to that 4770 level. But probably the more intriguing piece was the fact that with today's move on the very long-term 50-point per box chart for the S&P 500, we've seen it break out at 4750 and give a ninth consecutive buy signal. It's been interesting, and it's good to gain perspective by using some of these longer-term charts because you can look at, takes out some of that near-term noise, and it's nice to take a look at that 50 points per box chart because it does show, obviously we've been in a little bit of a range between here and 4,500, but the fact that we're breaking out to the upside here gives confirmation that we're seeing some of that return to upside movement out of many of the indices. The other index that we wanted to mention here was the fact that over last week's action, we saw the Russell 2000 symbol RUT return to a buy signal for the first time since the first really midpoint of November. It moved up to new all-time highs there at 2440, fell to give 4 consecutive sell signals, but with last week's action, completed a double top formation there at 2220 and completed the bearish signal reversal pattern on the chart. So again, seeing the index charts return to buy signals. In some cases, we're seeing indexes make new all-time highs, and that has transitioned over for us to some action happening within the indicators. Now, we did talk a little bit last week in the reports and so on and so forth about how the indicators have moved around. In some cases, we've seen record movement out of the indicators. I know Will and I last week looked at the bullish percent for the NYSE, and it's actually had the most reversals of any given year here in 2021 on that bullish percent for the NYSE chart. But from a trending perspective, a pure just trending perspective, we're seeing a lot of those indicators that measure stocks, their percentage of stocks trading above their moving averages, such as the 10-week, the 30-week, and the 40-week. Each one of those is going to be tracking the percentage of stocks trading above their 50-day, 150-day, and 200-day moving averages. And we've seen those again pick up and increase. We saw them turn south a little bit in the prior week, but with this last week's action and really moving on into this week, we've seen those uptick a little bit. In the case of the 10-week for the NYSE, it suggests that 40% of stocks are now trading above their 50-day moving average. On the 30-week, it's at 44%. And from there, with last Thursday's action, rather, since that was our last trading day, we saw the 40-week for the NYSE reverse up as well there at 46%. So still technically, you would say that most stocks are still trading below those moving average points. But overall, an increase in the fact that we're seeing stocks move back above them, and we're also seeing further action occur on the bullish percent. So with last night's action, or again, pardon me, I'll get it right eventually, with last Thursday's action, we had the bullish percent for the optionable stocks reverse back into a column of X's at 44%, which is the first time since the latter part of November that it's been back into a column of X's. And again, it's nice to see that increase in the indicators as it allows us to see participation coming back. And really also the fact that we're seeing these indexes break out is just another positive. But one of the things on the bullish percent front that I know Will wanted to touch on was some of the more smaller universe index bullish percents that we've seen. They've been fairly active as well, but he noted to me that a intriguing point about those 3 bullish percents has occurred after yesterday's, or again, Thursday's action. I'll get it right eventually.
Yeah, David, I did want to mention those 3 bullish percents, the 3 being with a bullish percent for the S&P 500, bullish percent for the mid cap 400, and then the bullish percent for the small cap 600. Those each reversed up following Thursday's action, and they each reversed up on the same day. And that's only happened about about 9 times over the past 20 years. First one came in 2006. In July of 2006, we had a couple occurrences in 2008 of this happen with elevated volatility there. Of course, 2011, 16, twice in 2020. Interesting date, 3/17/2020, so March 17th, near that market bottom. You saw 3 of those reverse up together. And then May of 2020 as well. Most recently, December 7th of 2021, this actually happened where all 3 reversed back up into X's, saw some lateral movement, and now they've done it again following the action on 12/23. So if you look forward from those past occurrences, generally positive returns, as you may expect, increased participation across all sizes, especially small caps. That's something that, like David mentioned, we've really been wanting to see get going. That Russell 2000 chart has been extremely consolidated in that trading window. So that bullish pattern on there and that breakout is something that kind of confirms that strength is broadening out. There is some more risk appetite being taken in the market. So we don't want just the mega caps be holding the index together. If you listen to other market technicians, this has been a popular critique or a popular kind of bearish sentiment, or for why people are bearish right now, is that participation levels are weak, breadth is declining, as often said. So with these bullish percents, we're seeing some evidence that more breadth is occurring into the market across a variety of sizes. So this is a good development. The only real point of concern on those forward returns was that September 2008 occurrence, where on I would say 3 months and 6 months out, those were of course negative, but often than not, this was a positive occurrence. So we can take this as positive picture. Still like to see these get above the 50% level, at least all being above that 50%, typically a healthy line of demarcation. But the period, or the last sentence I'll say here, that's a positive move, not a frequent move that we see these all move together, but gives us some more conviction, at least for the near term here.
Well, and that's the thing. That's really the finally getting an answer to some level of uncertainty. That's where a lot of folks will take these reversals, and especially, as you noted, those climbs back above 50% for really any of the indicators, just showing that you're seeing a majority of positions doing, either returning to buy signals, moving back above their moving averages. So it's nice to see that, like you said, breadth come back. Now, we are nearing the end of the year. It is that period for the Santa Claus rally. We are actually right in the throes of it at this point in time. And we had a tough start to the month of December this year, but it's since rebounded a little bit and has shown some nice performance. So at least giving an idea that maybe Santa Claus did return to the markets this year, but again, we have a few more days of trading left, so we'll see how that pans out. But one of the things that we wanted to finish up on today is an entertaining take on the 12 days of Christmas. I know Will had messaged me this morning and messaged me this 12 days of Christmas, and you explained it much better than I can at this point.
Yeah, I won't go through the whole thing, and if you reach out to us, we're happy to send you this link. But essentially, the folks at PNC Bank in Philadelphia have done this for a while, and they look at the 12 Days of Christmas song, kind of the anthem, that chorus, 5 golden rings, 4 turtle doves, 3 French hens. I don't even know if I'm saying the right ones, but that's the song that we're going for. And they actually did an inflation adjusted 12 days of Christmas. So it says, how much do these 12 items actually cost you now compared to when the song was written, or even over the past couple of years? A few funny ones that I thought I wanted to mention that you may have never heard before. Apparently the price of turtle doves are up over 40% since 2019. I'm not sure who's buying these things, but they're up over 40%. French hens are up over 50% over the same time frame, according to PNC. They say that the rising cost of bird feed is your reason there. And then strong demand from consumers, they cited as well. 6 geese a laying. So 6 geese are up price is nearly 60% over the past year. Golden ring, so precious metals, up 8.5% since 2019. But once you get more to the entertainer side of the 12 days of Christmas, so 11 lords a leaping, 10 ladies dancing, 9 pipers piping. Wage growth has picked up lately, but by and large, those are still up just a marginal fraction, about 5% or so over the past year. But I thought that was really entertaining, and somebody did some decent work on that.
And who knew the popularity of birds as gifts? I mean, at this point,
yeah, maybe carrier pigeons are coming back.
Well, either that or maybe that's the next index we need to talk to folks about is if there's any futures contracts on bird products out there that we can go trade. Because
bird seed.
Yeah. And bird seed, all the French hens, the turtle doves. I can admit that I've never seen either one of those, but the fact
can't
that
say I have either. Yeah,
there's a market out there and somebody's buying it and somebody's getting rich off of it. So hey, good on them.
Yeah, something else online that I was reading as well, kind of Santa Claus rally year-end-esque, was a report from Piper Sandler talking about this Santa Claus rally. So if you aren't familiar exactly what the Santa Claus rally is, I think it's important to say it's that seasonal buying bias from the last 5 trading days of the year through the first 2 trading days of the new year. So it's not exclusively to December, but it does carry over into the beginning of the new year. But listen to this, since 1928, the average return for the S&P has been 1.7%, which is much higher than your average 7-day period of about 20 basis points. And it's got a pretty good batting average. So 79% of the time during the Santa Claus rally, the index is positive, compared to 57% apart on the other 7-day periods. And I would say, looking ahead to the next year, this is something that isn't often talked about, but looking ahead to the next year, this is according to Piper Sandler, when Santa does deliver positive returns, forward SPX price returns over the following year have averaged 8.3%. Median is over 12%. But when we don't get the Santa Claus rally, meaning that 7-day stretch, last 5 days of the year, first 2 days of the next year, if that's negative forward annual return for the next year, we're only about 4.5%. Median was 2.5%. So not to say that this is any material predictor of what the market's going to do next year, but there is some pretty interesting notes on that I did want to share before we signed off today.
Intriguing, to say the least. And hopefully we will cap off this week in a positive way and start early next week off in a positive way as well to cover that period and see if we can charge on into 2022 with some positive action going on. But as we noted, as we move into 2020 year, we're seeing indexes move to new all-time highs, at least in the case of the S&P 500, some trading near their all-time highs, and also seeing participation increase in many of these indicators. Not quite to where we would want to see them, but overall still a positive that we're seeing all of those things increase in tandem as we come to close out the year of 2021. So I believe with that, we will go ahead and sign off for our final podcast of 2021. It just dawned on me. We would join you again in 2022 next week for our next version. Seth, thanks for joining us.